How's it going, guys? Welcome back to the channel. We're going to be doing an evaluation of Logitech. You may know this company because if you're at a computer or if you own a computer at some point in your life, you probably own some Logitech products. They've been around for quite a long time and they make some pretty decent items. So let's just jump right into the evaluation here. We have Logitech pulled up. And let's take a look at what we should be paying for this company. So first off, let's look at the company metrics, compare them to where they are now from where they were. Currently, we have the PE at 18.9, or sorry, 18.19. That's good. We want this number to be under 20, and the 5-year average is 23.55. So we're already in a good spot, at least this year. EPS for the trailing 12 months is at 4.53. Our average EPS has been 2.48, so there is an improvement here. That's good to see. ROE 32.90 compared to a 5-year average of 27.57. We want this number to be over 15%, and for the 5-year average and for the current trailing 12 months, it's double that. Great to see it. Love to see it. All right. So profit margin 13.17%. I don't know. I keep saying 7, and I said 9 over here. Anyways, 13.17%. That's great to see. I don't know why I said that's great to see. Like I'm looking for a specific number, but I mean it's higher than the 5-year average. So listen, that's an improvement. I thoroughly enjoy that. Revenue trailing 12 months, $5.7 billion. Net income is $762 million, followed by free cash flow at $635 million. All right. Let's look at how that compares. So on this other side of the category, we got, at least on the other side here of this column, we have a dividend yield of 1.16%. 1.16% dividend yield. That means we're paying out $146 million from our average of $518 million free cash flow, so they can cover that like almost 5 times over, maybe like 4 times over. So dividend is safe. That's an important thing to look out for. You want to make sure the companies that you're looking into can pay out the dividends. You don't want to be stuck in a dividend trap, because dividends are attractive to most investors, but if the company's struggling to pay them out, not so attractive no more. All right. Wow. Is this real? Return on invested capital is 35.95%. And 5-year average is 24.97. That's actually that's amazing. We're looking for this number to be over 10%, guys. Triple that. And double that for the 5-year average. That means this company does a really good job of investing their capital. Yeah, love seeing that. So 5-year pretty consistent, and this year they're doing amazing. Phenomenal numbers here. Almond Z-score. Let's go on to this. 8.09. We want this number to be over 3, guys. Essentially, what Almond Z-score is a calculation to see how safe the company is from bankruptcy. The likelihood of them being bankrupt or going bankrupt in the next couple of years is very low. It doesn't particularly translate well to tech companies. So even though this number is impressive, take it as a grain of salt. The next metric we're looking at, the Piotrowski score. Logitech is sitting at a 6. We want this company to be, or we want to look for companies that are in the 8 to 9 range. Makes me feel warm and fuzzy inside. Being at a 6, it's kind of a mediocre. It's kind of a mediocre number. I'm not too thrilled about it, but I digress. It is what it is. All right, here we go. That's the company metrics comparison. On to financial evaluations. We have a score of 8 out of 10. So let's go through that quickly. 5-year PE ratio average is 23.55. So it's going to get 0. I'm not too concerned. 23 is within our 20 mark, so it's all right. It can I'm not like super worried about that. And plus, our current PE ratio that we have now, as we discussed, it is 18. So that is actually pretty decent. Current ratio, we want this number to be over 1.5, and currently it is at 2.05. So that is good. The current ratio is essentially a comparison of how many assets the company has on hand compared to its liabilities. So obviously, a 1-to-1 ratio would be the amount of assets can cover the amount of liabilities if the company had to, let's say, liquidate itself. So 1.5 is ideal because if the company had to liquidate, let's say, one asset for another one liability, that 0.5 is your buffer that, the company won't be completely, let's say, wiped out. A ratio of 2.0 is phenomenal because now you have a ratio of 2 to 1. So you can wipe out your liabilities and you still be left with some assets in case that emergency scenario that the company needs to liquidate and do you know capitalistic things. Lost my train of thought, but essentially that's what this current ratio is. And enough of me blabbering along. Return on equity average, 5-year average, it is 27.57. Like we said, we want this to be over 15%, and we got that. Logitech, boom, you get a point. EPS growth, we have it at 462% increase over the last 5 years. Phenomenal. That means, earnings are growing per share. So as a shareholder, we want to see this. We want to see this number growing. And as you can see here, the current EPS is definitely much of an increase. It's definitely has increased over the 5-year average. So love to see that. Oh wow. Debt to equity. Guys, this is probably the lowest number I've seen so far. I mean, I don't have much to at least base it off in these videos, if you're following along and subscribed. But this number here, we want this number to be under 50%. It's at 0.94. That's phenomenal. And what this ratio is, or what this ratio looks at, is how the company is using, or how it's leveraging its capital. So you can either leverage your capital through one or two ways: debt or equity. Are we taking on debt to make some financial moves, or are we building equity within the company and then kind of going through that way? So what this screams to me is that this Logitech is building a lot of equity within the business and not taking on that much debt. Love to see that. That's phenomenal. I mean, that also probably shows and is reflected here on this return on invested capital. They're getting high returns from their equity. So that makes sense. So that is really good to see. Okay. Good job, Logitech. I feel like I'm like a proud father, like patting a son on the back, like, good job, kid, you're doing great. Okay, it's like a report card. Share dilution. Okay. This one is an important metric here because we want to see the company issue less shares or buy back shares, and Logitech hasn't been doing that. Over the last 5 years, there's been a 1% increase. And so for those who don't know, or why this is actually important, because when a company dilutes you, they're taking away ownership of the company from you, right? So you ideally want to be, you want to have as much ownership as the company as possible. The more money you put into the company, you want to see you want to have a bigger piece of the pie, right? And when they're diluting shares, they're just adding more slices, or they're cutting up more of your slices that you currently own. Imagine you're having a slice of pizza, and then someone says, "Oh, I want a slice too," and then the guy that bought the pizza cuts up one of your slices up and gives it to the next guy. Well, you still have your one slice of pizza, but it's less. You know what I mean? Or so we don't want that. But unfortunately, Logitech's doing that. Yeah, it's a 1% increase over the last 5 years. Not too thrilled. It's not a huge increase, but still it's an increase nonetheless, so it gets a 0 in that category. 5-year net income growth, 360% increase. So huge growth over the last 5 years. Same with free cash flow growth, and obviously that is amazing to see. So point there. 5-year return on invested capital average, as we discussed, 24.97. We want to see that over 10%, and they're crushing that. Now, 5-year revenue growth, 23.50%. That's actually pretty good over the last 5 years, so it gets a point there. So all in all, 8 out of 10. The PE is not really too much of a concern to me because it's low enough for this current year, and if they can keep that up, that'd be awesome. The share dilution, as long as they don't issue more shares, I'll be happy. But I want to see them buying back shares. Now, let's do an evaluation on the price to see what it's currently worth. Because if this turns out to be an undervalued stock, then they should be buying back shares. That's like one of the best things you could possibly do, I think, as a company. All right, here's evaluation, 10%, or sorry, 10 years, and let's jump into our metrics here. Okay, so immediately right off the bat, I'm not gonna go with this number at all. And if you've been watching my videos so far, you know I like to hover within the 10 to 5-year range, mostly gravitating towards a 10 as like a what if, because I like to be conservative. But this number here, the reason for this jump, definitely because of COVID. People are working from home, so they're going to be buying more office equipment, and Logitech is like the office equipment, I would say, standard. Like you're buying your keyboard and mouse, you're most likely going to go with the Logitech. And so yeah, that increase right there makes sense. People are at home, so we're going to stay away from that. Let's go, without further ado, let's go 10, 11, and then 11.5. That way we get the 10-year number in there, and then we should stay a little bit. And you know what? Keep in mind. Go 11.5 for the moderate. And then I'm gonna get brave. Go 12. See how that is. Profit. Oh my god, the 10-year number is absolutely horrific. 5.81. 11.6. Alright. Sure. Let's go. Not 55. Push. 6. How about this? How about this? Oh no. This will go 6.5. 7.5. Being a little bit more liberal here with that 7.5. Free cash flow margin. What do we got here? 10 and 15%. I'll go 10, 11, 12. How about that? Price to free cash flow, 21.42. My go-to is always like 14, 16, 18. I feel like that's decent. With a PE ratio of 18.9. Yeah, you know what? Like, yeah, let's see. Let's see what happens. If I can keep that PE ratio, yeah, why not? Desired return, we go with 13%. Oh boy. Oh boy. Yo. Alright. Oh my god. I got hyped for that. Not bad. Not bad. Based off these numerics. We got 126 on the high side, 70 on the low side, and then 100 slap dead in the middle, with 99 being our average. 46 being our super low side on the earnings multiple. Huh. I definitely wasn't conservative with these estimates. Or else. But I'm actually quite impressed. Yeah, no, definitely something to take a look at these current evaluations. It's, if we believe these are the valuations to be correct, then yeah, it's a buy all the time. So let me go ultra ultra conservative and kind of see where we might be. That was, hold on, refresh. I think this makes sense. At a the only thing that doesn't make sense is probably these numbers right here, because I think over 10-year over a 10-year analysis, the PE should be going lower. You should be probably paying a lower multiple for that. So, yeah, let's clear. Try one more. So we have $100 as an average price. Current price is 80. Not bad. Let's take a look. Let's do 10, 10.5, 11 profit margin. Let's do 5, 5.5, then 6. You're probably asking yourself, Leo, why are you being so conservative? Because like you have to be. You kind of have to assume the worst and expect the best, right? And that's kind of counterintuitive, but like you know what I mean. Like you have to give yourself a margin of safety, because if you are wrong, you shouldn't be wrong by a lot. So free cash flow margin. I am definitely gonna go with 9, and maybe like 10, and then like maybe like 10.5. And then free cash flow, I'm gonna go low. I'm gonna go lower. I'm gonna go 12, 14, 16. And then PE ratio, definitely gonna go like 10, 12, 14 on the high side. And then 13, let's see what we got. Okay, we got some green in there. But, okay. That makes a little bit more sense. These are based off more conservative multiples, guys. So we've dropped quite a bit from our $100 evaluation. Now we're at 72.55. Moderate is here at 73, with conservative at 55. We did hit a couple of greens over here. Hit a couple of greens with DCFs. Even on the high side too, guys. Like with a PE ratio of 14 and the price to free cash flow at 16, the free cash flow margin of 10.5, like that is just in the middle of the 10-year and 5-year number. It's not bad. I gotta do more due diligence on Logitech, but definitely this is something that's in my watch list. Now, I believe it's the $99 price that we came up with? No, I really do think it's probably more so in this wheelhouse. I think if you pay the $73 or 72 in this range here, you can make that 13% return. And the reason I do 13% return, I don't know, lucky number 13, but also you can throw your money in like an ETF, and then on average, the S&P 500 averages out to be around 9 to 10% a year, something like that. So, like I'll put something higher to give me like a margin of safety. Like even if I do like a 15, like oh man, okay, at 15% return, we're looking at 67, 68. So, well, this screams out to me, at least based off of these numbers that I plugged in, $70 for Logitech. It gets down to that price. It's something to look into. The brand's recognizable. They have an increase on their revenue, the free cash flow, the return on equity is, the return on invested capital is great. But yeah, free cash flow is awesome. Net income growth is awesome. Revenue growth has been improving. And with people working from home, here's another thing, guys, that you gotta keep in mind. With people wanting now to work from home, I think you'll probably see a lot more people purchasing their products, because now people are going to probably start developing their own home offices, and they have a really good product line. I think that's just, do this. I just think that's what's gonna happen. So I think they're in a good spot financially. Logitech, and they have a good debt to equity. Like I'm a big fan of their financial valuation. The only thing that's kind of a red flag to me right now is just the share dilution. As long as they can kind of keep the share dilution low, and if maybe even buy back some shares, like at the current price, doesn't make sense to me for them to buy back shares, because now you're kind of buying an overpriced stock, and that's kind of like just burning through your free cash flow, and that doesn't make sense. But all in all, I would do some more due diligence on Logitech. I'd probably put a little price alert when it gets down to that $70 range, maybe even like 65, just to be sure, like just in case. But yeah. So folks, those are my thoughts on Logitech. I think the company is great. I think the company has a lot of potential going forward, especially with people staying home, working from home. What I want to see for this company is to drop to the price south of 70, and then definitely probably be my wheelhouse to maybe pick it up. But that's those are my thoughts. If you like this video, if it helped you out a lot, please drop a like, hit the subscribe button. It helps me out, helps the YouTube algorithm, and then we all win. Also, drop a comment on companies that you want me to evaluate. And guys, I'll see you in the next one. Take it easy.